And start up. Welcome, participants, to another SCORE webinar. I'm excited today to have Andrew Bosserman with Boss Tax Law back with us, presenting on make the right tax and legal choices before you start your business. There's some great content in this presentation that I think everyone will be able to use. And we hope you enjoy it. It is right at the noon hour. We have about 38 participants on the line now, and we'll be starting in just a moment. In the meantime, a couple housekeeping items. I would like to ask that everyone that's attending to put in the chat their name and location. But I do also ask that the questions can come through the chat, but they may get lost. I believe there is a Q&A function that can be used, but I'll try to monitor the inbound chat, and Andrew will be as well. We'll try to pick up all the questions. A couple of the common questions. The presentation deck will be distributed to all of those attending within the next 7 to 10 days. So that should address a question or two. First, I'd like to start with SCORE. Hopefully everybody that's attending, and we're now up to 55 folks, is familiar with SCORE and monitor the inbound emails and newsletters that advertise these very useful and resourceful webinars. Just initially a bit about SCORE. SCORE volunteers are successful and experienced business executives. I ran a manufacturing company myself. My name is Dave Myers. Ran a successful manufacturing myself for 45 years, and I retired a couple years ago and just wanting to give back to the crowd, whether that be through moderating a webinar with Andrew Bosserman, one-on-one mentoring, etc. We also provide educational programs similar to this webinar. There are live webinars that are, I think the count is about 50 live webinars through the year now. The library of archived recorded webinars are available through our SCORE website, score.org/Charlotte. And then we have community outreach events that are in-person networking events. Those can be found on our newsletters. So please monitor those newsletters. If you haven't signed up for those, please, again, go to score.org/Charlotte and sign up for the newsletter. SCORE has 9 chapters in North Carolina and chapters throughout the 50 states. And there's about 10,000 volunteers throughout the U.S. In the Charlotte region, we have about 95 volunteers. We have inbound SCORE clients at a rate of about 200 a month. So there's a lot of good activity. We have a wealth of mentors who can help you during your journey, whether that be taking it from conception to launch or to the next couple of years. Well, without further ado, I'd like to introduce Andrew Bosserman, our keynote speaker for the day. Andrew?
Great. Thanks, Dave. And it's great to be back again presenting another SCORE webinar. Let me share my screen and we can get into it. So this presentation is make the right tax and legal choices before you start your business. So this should be applicable to a lot of you out there. I'm assuming many of you are either thinking about starting a business, in the process of starting your business, or just starting your business. So we're going to go through a number of things, tax and legal wise, that should be helpful to you and things you should think about. Um, I am a tax attorney. Mainly, I focus on IRS disputes, so people who already have an IRS problem. So I hope that's none of you out there, that none of you ever need my help that way. But I also have to know tax law, and I also used to do some work as a business attorney, more so on kind of the forming startup businesses, helping businesses merge and sell. So I have some experience with that as well, and hope to bring all of that in to our presentation. So what I'm going to talk about today is really four things. So we're going to talk about different entity options and the tax classifications that go along with those. Then we're going to talk about handling startup expenses, which many of you probably have or will have. We're going to talk about the home office deduction, which many of you might also have, especially since post-COVID. You know, a lot of people work from home. I primarily work out of my home office, so definitely utilize that one. And also, we're going to go through depreciation, which you've probably heard of, but it can be confusing, and we'll go through the basics of depreciation. And also throughout, like Dave said, feel free to put questions. There's that question and answer function. If you don't see it on your screen, I think if you go to more, you should be able to find question and answers. And then I'll try to stop throughout and answer questions when they most make sense. And we can also talk about questions at the very end. So let's first go through entity options and tax classifications. So let's kind of start by zooming out and talking about the basics. Why do you want to use a business entity? And when I'm talking about business entities, I'll go through the most common ones next, but these are things like corporations, LLCs. Why do businesses have a separate entity? Well, it's to avoid legal liability, because if you're not doing business through an entity, all your personal assets could be at risk. So, for example, you could be held personally liable for business debt, say if the business borrows money, or say something were to happen and the business were to get sued, all your personal assets could be at risk, which we don't want. You're taking on enough risk by starting a business, putting yourself out there. You don't potentially want to lose everything you have if something goes terribly wrong, especially if you have, a lot to lose. But by utilizing a business entity, generally only your business assets are at risk. And that means generally the money you contributed to the entity is the amount you could lose. So, you put in $10,000 to start your company and don't put any more money in. Generally, that's like the most you could lose. They can't, if something goes terribly wrong, you can't get sued for, more than that. They'd be limited to collecting against whatever assets the business itself has, but not you personally. For example, like your house couldn't be at risk. Now, there are exceptions to that, but that's the general reason why you want to have a business entity. Also, it just helps with your appearance to the public that you're a legitimate business. If you're out there providing services, it's the same as kind of like using a Gmail account. It's a lot better to have your own domain doing business, because if you're just doing business out of, say, a Gmail or Yahoo account, people might be like, oh, is this person actually legitimate? And it doesn't cost very much to get your own domain and set up email there that way. Similarly, doing business through an entity, if you have an LLC or corporation, that's seems a lot more legitimate than just doing business as Andrew Bosserman, sole proprietor. So that's another benefit of it. And now let's talk about three possible choices for a business entity. Now, these aren't all the possible choices, but they are, I would say, the three most common. So you could be a sole proprietorship, you could be a corporation, or you could form a limited liability company called an LLC, which you've probably heard of and is the most common one. So let's just compare these quickly. A sole proprietorship, this is the default if there's only one owner of the business and no entity is formed. So you just decide to start business one day. Myself, I just decide to start mowing lawns. And so I just start doing business in my own name as Andrew Bosserman. lawnmower. But if I do that, that means that I have no personal liability protection. So, for example, something goes terribly wrong in my lawn mowing business and someone gets injured, that means all my personal assets are at risk. Um, Another option is a corporation. So the benefit of a corporation is that you have limited liability. So there's that personal liability protection. And there can be one owner, or there can also be multiple owners. And those are called shareholders in a corporation. So if you've ever bought a share of stock, on the stock exchange, you are a shareholder in a publicly traded corporation. The downside to corporations, which we don't really like, is that they have lots of formalities. You have to have a board of directors and you have to have regular meetings where you take minutes, which is just, a record of everything that happened. And they just aren't as flexible as other options like LLCs. And that's why I have the LLC highlighted in green, because really it is the best option and recommended option in almost all instances. So LLCs, similar to corporations, you get that limited liability. So your personal assets are protected, and you can also have one or multiple owners. Instead of being called shareholders, they're called members in an LLC. And we like LLCs because they're very easy to form and maintain. You can form one by just going to the Secretary of State's website in your state. I know most of us on this call, it looks like a lot of people are from North Carolina, which is where I am also. You just go to the North Carolina Secretary of State's website, you fill out about a one-page form, pay a filing fee, and you have an LLC. Also, they're very flexible. You don't generally have to have, regular meetings or a board of directors, although you can have those things in an LLC, but they're not required. It's also very easy to add additional owners. So if your business is expanding down the line, you want to bring in investors or say merge with another business, that's really pretty easy to do, less complicated than with a corporation. So that's the business entity. So this is the legal entity, how the Secretary of State looks at it. But we also have to consider tax classification. So business is how the um, the courts or the law looks at your business, but the tax classification is how essentially the IRS looks at your business and how it will be taxed um, under the Internal Revenue laws. So the four possible choices for an LLC, and I'll go over LLC because really that's probably what you should be forming if you're forming a business entity, and what I would generally recommend in most situations. You can be taxed as a sole proprietorship, a partnership, an S corporation, or a C corporation. And you may have heard of some or all of those, but we'll go through a comparison just so we can see the differences. So a sole proprietorship. So this is the default tax status if an LLC only has one owner. And oftentimes this is called a single member LLC, because if you remember, the owners of LLCs are called members. And this is very simple because it is just reported on the owner's individual income tax return. So every year you file Form 1040 to report your individual taxes to the IRS. And on there, if you have a business tax as sole proprietorship, you would file what's called a Schedule C. So it's a simple two-page form. Really, the first page is the most important, and it's just a list of your income and expenses. And then it comes to a net profit, which then gets taxed. We also, sole proprietorships, like I say, it's easy because you don't have to file a separate business tax return. Everything's just taxed in your personal return, and it's very straightforward. Also, if you start out this way, which many businesses do because they normally start with, one owner starting the business, you can elect other tax statuses in the future if desired. So you could start out as a sole proprietorship and then elect tax status to be, say, an S corporation or a C corporation, or even a partnership, if that applies in the future. So remember, This is LLC already, but it could be taxed as any of these ways depending on um, the number of owners and how it's viewed with the IRS. Another way an LLC could be taxed is a partnership. So this is the default if you have an LLC with multiple owners. So an LLC with multiple owners can't be a sole proprietorship because remember, sole proprietorship can only have one owner. But if you have multiple owners, then the default status is a partnership. And this does now require a separate tax return. So you'll have a little bit more filing and tax compliance costs. But partnerships are nice, or I should say, partnership tax status is nice because you can have flexible ownership and profit allocations. For example, there are some rules, but you could generally allocate, if one partner puts up a lot of money, the other person puts up sweat equity, you can allocate profits distributions, not always in accordance with how much money was contributed. You can sometimes allocate gains and losses differently, and there's a whole bunch of things you can do with partnerships, which can be flexible. It's also a lot easier to add additional owners or incentivize employees or workers in the business with, say, kind of like they're not stock options, but it's similar for, if the business were to sell, they can get a piece of the action. So that's partnership tax classification. You can also be taxed as an S corporation. And I'm sure you've heard about this if you've spent any time on social media, because I feel like at least I come across a lot of things that says, oh, make sure to elect S corporation status for your business because you'll save lots of money on taxes. And while that can be the case, as with all tax advice you see on social media, there's always a it depends answer. So to be taxed as an S corporation, you have to make a special election, and this means it's not default status. If you're, regardless of your LLC has one member or multiple members, you have to file a form with the IRS to elect S corporation status. Then you also have to start filing a separate tax return. One of the benefits of S corporation status, and really mainly the main benefit, is that you may be able to save some employment taxes. Because if you're the owner of the business, you have to pay yourself a salary. But then if you have additional profits above whatever that salary amount is, that can be distributed to you free of self-employment taxes. So there's some tax savings to be had there possibly, but it generally doesn't make sense, I say, until you have at least $100,000 in net profit, just because you're going to have additional costs of having to file a separate tax return. So you're going to have to pay an accountant probably at least a few $1,000s to file a separate S corporation return. You're going to have to set up payroll for yourself, pay yourself payroll. So there's ongoing payroll costs. And just also the added complexity of having to deal with, all of that. So that's why I say it generally doesn't make sense until you have at least $100,000 in net profit. Also, there are ownership restrictions with S corporations. So to be an owner of an S corporation, you have to be a U.S. citizen. Like foreign nationals can't own S corporations. Also, only certain trusts can have an ownership interest in S corporations, and restrictions like that. So that can be a potential issue depending on either your naturalization status or some of the investors maybe you have, or looking down the line. I've also seen issues where it costs a lot more legal work later down the line when a business is trying to sell and they're an S corporation. Now, I'm not saying you shouldn't become an S corporation. If it makes sense, definitely do it. But I would say weigh the pros and cons before making an S election, because when you do so, it's very hard to undo. And there's generally some tax costs associated with that. But like I said, if you're a sole proprietorship or even a partnership tax status, you can always elect S corporation in the future. So it's very easy to do it, become an S corporation, but very difficult to unwind it once it's happened. And finally, we have C corporations. So C corporations is the tax status of essentially all major corporations. So all publicly traded companies, but also small companies can be taxed as that. If you're an LLC, you also would have to make an election to be taxed as a C corporation. Or if you were to form an actual legal corporation, which most people don't do nowadays, this would be the default status, but you could elect S corporation status if desired. The reason why we oftentimes don't like C corporations is there's a thing called double taxation. So this means that the net income of a C corporation is taxed at the corporate level once on any profits. And then once a shareholder gets a distribution, which is called a dividend, that is also taxed at the individual level. So it's subject to double layers of tax, which can oftentimes, though not always, result in a higher tax burden. And so generally it's not recommended for small startups unless, large growth is expected, because there's actually a special provision in the Internal Revenue Code where if you're a qualifying business and you're a C corporation, you can exclude a lot of gain on the sale of your business if you hold the stock for more than 5 years and meet a number of other requirements. So a lot of technology companies will qualify for that. But generally, starting out, C corporation status, isn't recommended, especially for service businesses, because they're not going to qualify for that. So this is an overview of the tax statuses. So remember, legal status, the entities, like being a sole proprietor, being a corporation, being an LLC, that's different from these tax classifications, which is how the IRS looks at them. So once you've figured out your entity, formed your entity, figured out your tax classification, there's also a number of other things I recommend. So if you're forming an LLC, you definitely want to draft an operating agreement, which is really a contract between you and the LLC that spells out, how the profits are to be shared and who has management rights. Very important if there's going to be multiple owners. You also want to get an EIN. You want to set up a business bank account, sales tax number if you need it, and also set up a bookkeeping and record keeping system. So I was, my first job out of college, I was an IRS agent, meaning I audited small businesses, their tax returns to see if they were correct. And most of the time, when small businesses owed additional tax, it wasn't because they were trying to cheat the system or do anything shady. They just kept bad books and records. Either they made mistakes in bookkeeping because they tried to do it themselves, or they just didn't have receipts, invoices to document kind of to just prove what was on their tax return. So all these are important and are definite things to do after forming your entity. So this is the end of the entity tax classification status section. Let's see, Dave, any good questions that have come in we should talk about?
There are several. Andrew, this is just some great information and very important. We do have a number of very good questions. One that relates that I've been involved with. You mentioned the starting of the corporation and the tax selection, which are important and strategic in the beginning of a business. Well, that strategy might alter at the exit or a sale of a business. The question is, can the selection, election, and status change during the life with some requirements involved?
Yes. So you can generally change it. I'll go back to the classification slide, but you can generally change it throughout. So I would say if you're in 1 or 2, that's going to be the default status. If you're an LLC, whether you have one owner or multiple owners, one owner, sole proprietorship, two or more partnership, you can make an election to at any time to become an S corporation or a C corporation. And that's very easy. What gets more difficult, although you can do it, you can revert. So you could go back from being an S corporation to being a sole proprietorship, or go back from being a C corporation to something else. But that generally it's doable, but you generally incur some tax costs that oftentimes you don't want to. So essentially before you become an S or C corporation, you really want to have a discussion with an accountant and or a tax attorney, just because it's one of those things that's easy to get into but hard to undo. And if you are thinking you might sell your business in the future, you definitely want to bring that up because um, some things may make a sale more difficult. Now, there's always ways to fix things or make it work, but it's just good to be aware of all the potential consequences before you do make one of these tax elections.
Great info. Great info. Andrew, let me just go through a couple of these questions. First is, how is inventory affected between an LLC, Corp, or S Corp? And are there better tax breaks in any of these entities? And this is referring to inventory of some type.
It's going to be all treated the same. The same essentially accounting rules are going to tax rules are going to essentially apply to whatever tax status you have. Everything, how to compute your net income, because ultimately you are taxed on essentially the net income of the business. But what changes is, like for S corporations, you're able to save some self-employment tax. Now, that doesn't necessarily save income tax, but does save some employment taxes. But the calculation that inventory would be involved in, that's going to be the same across all tax classifications. So it's not going to make a difference.
Well, great. We've got about 6 or 7 questions, so I'll go through these promptly. Which form, and I guess corporate form, which form does single member LLC use to pay quarterly? Oh, no, it's actually a paper form. Which form does single member LLC use to pay quarterly tax?
I'm going to I'm going to assume you're talking about income tax estimates. So that's reported on your um, individual income tax return. So you're going to make estimates using the form 1040 estimate. I think it's 1040 ES or the estimate vouchers. But you just make estimates under your personal name because really a single member LLC, the IRS doesn't view it as a separate entity. They just view the single member LLC as essentially yourself. So that's how that works. And payroll taxes would be paid separately, but those aren't quarterly. So I think you're referring to um, quarterly income tax estimates. So you could do those with the 1040 ES, or it's really easy. I pay estimates online through irs.gov, and that's a quick and easy way to do it.
Okay, next question. How are officers different from multiple owners?
So, an officer in the business is someone who generally manages day-to-day operations. So, like a CEO, a CFO. I'm talking about big businesses here, but those are titles. The officers don't necessarily have to be owners. So, I'll use a corporation as an example because it's like what all the big businesses are. So the shareholders will elect directors who sit on the board of directors, and directors generally determine long-term strategy and, big overarching goals of the business. And the directors are the ones who appoint the officers, essentially the managers of day-to-day operations. Now, for small businesses, generally, oftentimes they'll be one and the same. If you have a corporation, if you're the owner, you're also going to be, a director and also probably the main officer, the CEO of the business. But when the business gets bigger, there are, generally different people doing these things. But so I guess to kind of summarize your question again, an officer does not have to be an owner of the business. They're just essentially a day-to-day manager, but they could be an owner, but they don't have to be.
And an owner does not have to be an officer as well, correct?
Correct. Yeah.
Okay, moving on to the next question. Is tax filing the only time that's necessary to acknowledge your LLC's classification, or was there something I was supposed to set up when filing for my LLC? That may be where you mentioned by default earlier in the presentation.
Right. So if you're if you're going to be taxed as one of the default statuses, sole proprietorship or partnership, you don't have to do anything else. You just file your tax return properly. But if you're going to be an S corporation or a C corporation, you have to file separate election forms to do so. And generally, that's not when you form the business, but it doesn't necessarily have to be. You can do that at any time. So, like you see, the first bullet under both S and C corporation, it requires a special election. That means a special form has to be filed one time to essentially tell the IRS, hey, I want to be an S corporation, I want to be a C corporation. And then going forward, you just file the proper form. But no special election one-time form is necessary for a sole proprietor or partnership. And I'll go
So
ahead. I know.
that
Sorry, go ahead.
go ahead.
No, I was just going to say,
So go ahead, Andrew.
oh, no. I was just going to say, I know we're about halfway through. I'll start going through there's like the three other things we need to hit, and we can return to any questions at the end. But did you have one more kind of follow-up point to that, Dave?
Uh, the form, the special election form can occur at initial setup of a corporation or subsequent to that initial setup, correct? But it only needs to be one time once you're approved, and there is an approval process. And that's a question. Is there an
Yep.
approval process to that?
There is an approval process. The IRS has to, look at the form, approve it, and they'll send you a letter back. Sometimes it can take a while to get, but you will receive acknowledgement from the IRS eventually that they have accepted your, say, S election. So that's how it works. But
Okay.
let's move on to talking about startup expenses, which if you're starting a business, you'll likely have. So what really counts as a startup expense? What doesn't qualify? Equipment, vehicles, real estate, like hard assets, that's not considered a startup expense, but as we'll talk about, may qualify for depreciation. And startup expenses aren't ongoing costs after you open your business. These are expenses essentially prior to opening your doors or starting your business. And obviously, personal expenses unrelated to your business aren't deductible or count as startup expenses. Really, what startup costs are those costs you have, investigating and researching the business. When you're looking to get into a business, sometimes you incur some costs, maybe some professional fees, maybe some training, travel, advertising. That's essentially what a startup expense is. And how there is a special deduction for this. So the general rule is that you have to be in business to deduct expenses, but expenses are kind of an exception, a special rule. The year you open your doors for a business, you can deduct up to $5,000 in year one of startup costs. And if you have more than $5,000, you can then amortize, which essentially means deduct, kind of like depreciation, the remaining costs over a period of 15 years. These are costs before you open. So the next slide goes through this a little bit more, but the most you can deduct of startup costs in the first year you start your business is $5,000. And that's available if your startup costs are at or below $50,000. If you were to happen to have more than $50,000 of startup costs, then your first year deduction, that $5,000 is going to shrink. And then you'd have to amortize, which essentially means deducts over 15 years. So, for example, say you had $20,000 of startup expenses. I'm going to use this example because it's easy math. You would be able to deduct $5,000 in the year you open your business. And then for the next 15 years, you'd be able to deduct $1,000 per year. Because that's 20,000 minus 5,000 initial deduction. That leaves us $15,000 divided by the amortize that number two there over 15 years. So that's $1,000 per year. That's how I got that. If you happen to have more than $55,000, then you lose that initial $5,000 deduction and you just deduct all of your costs over 15 years. But so I'm talking about startup costs here, but I think the most important thing to think about when you're starting a business is to essentially start your business as soon as possible so your expenses aren't considered startup expenses. Because once you are technically in business, and generally that means you start attempting to sell your products or sell your services to the general public, then you move out of the startup phase and into the actual business phase, which then you can deduct all ordinary and necessary expenses. So really the key is just to start trying to sell something or provide your service or whatever your business is as soon as possible. And this helps with taxes because you can deduct those expenses and don't have to worry about this whole startup thing or getting trapped in a phase out or not being able to maybe deduct all your expenses and move them into just normal business expenses. Also, as you've probably learned, if you're trying to start a business or start a business, the best way to get started and just figure out what works and what doesn't work is to get started. Provide your service for someone, even if it's at a large discount, that would still count to being in business, or start trying to sell your product, going door to door, or whatever you have to do. So I go through all of this to talk about startup expenses because it's an important part of tax law. But I think what's even more important is making sure you open your doors, get in business as soon as possible so you really don't have to worry about that. Because the startup deduction, like number three, it's only cost before you open. So really investigation, research, pre-opening. But once you open your doors, it's just normal business expenses that can be deducted normally on your tax return. So I went through this section pretty quickly. I know a lot of you are probably maybe in the startup phase. But like I said, I think it's important really just to open your doors as soon as possible. Try to sell your product or provide your services, and then go from there because it will help your business as well as help you tax wise as well. So let's see. That's this was a shorter section than the first one, but Dave, do you have any questions about startup expenses? Let's see. I'm looking in the chat and Q&A now. Okay, yeah. So I do see a question that's good. It says, does the formation of an LLC start the clock for deductions, or does the LLC, cover deductible expenses? So forming the LLC isn't what starts the clock for having deductible expenses or being in business. It's actually really, tax law essentially says once you start, selling your product or service, is when you've really started in business. So one of the keys is just try to get that first sale as soon as possible. It's really when you start trying to sell. But for example, I actually used to own a small Christmas tree farm, and I also have advised Christmas tree growers on taxes. And Christmas trees are a unique business because it takes 7 or 8 years from when you plant the first tree to have a saleable tree ready, like a 7 or 8 foot tree ready for Christmas. So that's 7 or 8 years when you're like kind of in the startup phase, but you're waiting a long time and you still have a lot of expenses. So what I recommend to them is trying to sell something as soon as possible. So they could buy pre-cut trees from other farms to start selling. That would start their business. They could also grow other crops. Like I know lots that will grow pumpkins or sunflowers or other crops and start selling those. Or, have, say, school field trips out to the farm, things like that. So any way you can bring in money shows that you're in business and will, start the clock and provide proof that you're in business and, can start deducting all your ordinary necessary expenses rather than, have it just the startup expenses.
A couple other quick ones, Andrew, on startup. For startup costs, what is the required record for justifying those startup costs for an IRS audit?
Yeah, so generally it's going to be things like receipts, invoices. It depends on what the expense is, but most of the time when I was an IRS agent, we would look at, receipts. So generally it's best to keep a copy of the actual receipt, whether it's email or print receipt. Also keep, if it's on a credit card, keep your credit card statements. It's certainly best to have the actual receipt also so you can see more detail. But credit card statements. Um, if it's travel, uh, if you had to pay for travel, like a plane flight or other transportation, those are receipts. But if you're, say, driving around, keep records of, say, your business miles and a mileage log, things like that. But generally, it gets to receipts, invoices, essentially hard documentation of the cost that you spent for the startup costs.
So a couple other startup related questions. We move on to the next section. Will IRS accept a photo of a receipt as documentation? Photocopy conveyed, so JPEG format, can that be used in files?
Yes, they will. And I highly recommend. That's what I do. I take pictures or scan all of my receipts, save them in you know, online, Dropbox, OneDrive, one of those services, and those count. You don't have to actually have the physical receipt. It can be a copy or a photocopy. And I recommend that also just because you don't have all this paper lying around, you can't lose it. And it makes it easy to provide all the documentation to the IRS if you're ever involved in an audit. And also for things like, say, meals, stuff like travel and meals is subject to a little bit higher scrutiny just because there is some abuse with those. And also because it can also be, it's easy to have like personal meals and, claim their business, but they're actually personal. So if, say, you have a business meal, you also have to prove to the IRS like who you were eating, say, lunch with, and what the purpose of the conversation was. So what I do is when I have the receipt, I just write on the top like lunch with so and so. We discuss potential referral opportunities or something like that, and just take a picture of it, and then save it, and you're good. So you can also, it helps to write additional detail on it if you need it.
One last question before we move on to the next section. You had mentioned be prompt in the transition in startup phase to out of startup phase and make that sale. So the question is, why should we try to sell ASAP if that would move us out of the startup phase?
Because in the startup phase, you're subject to these limitations on deducting your expenses. So you can only get essentially, you can't deduct any expenses essentially during your, let me go back one slide that might help. So see, number one, you can only start deducting expenses once you've actually started making a sale. So I may not have made that clear, but that $5,000 deduction, that's when you actually start in business. And that's for the startup costs. But once you're in business, you can essentially deduct an unlimited number of expenses, assuming they qualify. So there's no limitations to that. So really, you want to get started as soon as possible, because you'll essentially unlock the ability to deduct all of your expenses. And also, you're going to start bringing in money, which that's kind of one of the main reasons why a lot of us start businesses is to, bring in revenue and create a business that either provides a side income or provides all of our income.
But we do want to assumably record all expense because that legitimately reduces your taxable income. Is that a correct statement?
That's right. So every expense you have that's deductible, that will reduce your income. And so, you essentially don't pay tax on your expenses if there's a way to think about it. So if you brought in $100,000 in your business and had $50,000 worth of expenses, you only pay tax on that $50,000 net profit, the 100 minus 50. So that's why you want to try to find as many legitimate expenses as possible. Now, I mean, don't go out of your way to just buy stuff you don't need. But, if you're incurring ordinary necessary expenses by running your business, you want to keep track of them so that you can deduct all of them and reduce your taxable income.
Okay, just one last question. It is regarding a nonprofit. The question is, do donations towards my nonprofit organization count regarding starting the clock?
So for a
So
nonprofit, yeah. That's a good question. This won't really. I will say I'm not an expert on nonprofit, but this generally won't matter for nonprofits because um, you're not really worried about. You have expenses, obviously, but you're not taxed on your income, so there's no really limitation like this. So essentially, if you're a nonprofit, you don't really have to worry about this. I would suggest if you're a nonprofit, though, there are accountants that specialize in nonprofits or have lots of experience. It's very good to get connected with one of those because the rules for nonprofit accounting and say for-profit business accounting, they're actually quite different. And a lot of accountants and CPAs aren't familiar with the rules for nonprofits. So that's one of the best ways is to just get a good accountant that's familiar with nonprofits. Um, okay, so
Okay, well, there are a number of questions, but let's do move on, and we'll try to circle back at the end of the presentation, Andrew, and catch as many as we can.
perfect. So let's now talk about the home office deduction. So this is a deduction you can take on your personal tax return if you are using your home for business. So there's a two-part test. Essentially, you must use the room you're using regularly and exclusively. So for example, I'm giving this presentation right now from my home office. It's a small bedroom in our house, but we actually don't have a bed in here. We just use it, as my office. It's hard to see because it's blurred, but there's like some bookshelves, there's a closet, there's a chair over there, and I have my desk and computer and everything. So these tests must be met. So first, it must be regular. So you must use whatever part of your house, room in your house you're using for business regularly. So that means on a continuing basis. They say in the tax law, frequent and repetitive. So I'm in my home office working, essentially every day I'm working. Now, it doesn't have to be every day for you, but it can't just be occasional use, like once a month. That's probably not going to qualify. It may, though, depending on the situation. But you would have to show the IRS that you're using it regularly for business. Also, and this is the tough one to meet sometimes, exclusive use. This must mean that you are using that room only for business. So, for example, if you have a guest room with a desk in the corner, that's going to fail if you're trying to claim the whole room for as your home office. Um, because if a guest ever comes and stay over, that would be personal use, and exclusive means like no personal use. However, there is kind of an exception in the tax law for a separately identifiable space. So that's like saying you might be able to deduct the small portion of that room that's the desk is in. That gets into um, you know, obviously your deduction, and we'll talk about, is probably going to be small if you can only deduct like, 5 square feet of your house. And also that could be under more scrutiny. That could be harder to prove to the IRS, if you were ever to go under audit. But the easiest way is to have a dedicated room that you are using just for business purposes. So you might be thinking, oh, how do we calculate this deduction or how much is it? There's two ways in tax law to do so. There's a simplified method. So that's $5 per square foot and it's up to 300 square feet. So that means you could get up to a $1,500 deduction on your tax return. It's called simplified because you don't have to keep any receipts for this. It's just figure out the square foot of the room you're using that qualifies and, multiply that by $5. And this one works out best if you don't want to hassle with record keeping or if your office is small. But you can also use what's called the actual method. So this is where you have to keep receipts and you deduct the share of home costs. So you would calculate all your rent or mortgage, your utilities, your insurance, repairs, things like that. And then it's prorated by the square footage. So for example, if you have a 250 square foot office in a 2,500 square foot home, let's say, I'm just using that for easy math, you could deduct 10% of your rent, mortgage, utilities, insurance, repairs, any qualifying costs. So in that sense, it may result in a larger deduction in that instance. So if you have a bigger space or if you're in a high cost of living area, then the actual method is probably going to win. But you have a smaller home office or just don't want to hassle with the math to add everything up, then you can do the simplified version. I actually do the simplified version on my own taxes for my home office just because it's quick and easy. And um, that you're also, I will say you're not locked in. You can switch methods year to year, but you do have to be careful if you're switching from actual to simplified. And that's because you can also take a portion of depreciation we're going to talk about in the next section, but when you deduct a portion of your home, and that's essentially a portion of the purchase price of your home. I'm saying be careful because when you go to sell your home later, that means some of the gain from the sale of your home may be taxed because you already deducted it on your tax return. So you just have to be careful with that and make sure you are keeping good records of the calculation if you're using the actual method. But really, think the main thing is make sure you qualify for regular and exclusive use. And the exclusive use, like I said, is the more difficult um, thing to use, or sorry, test to meet. And then, you can figure out the way to calculate your deductions. But the other benefit I will mention to having a home office is that um, generally your mileage to drive, say, from home to a business meeting and back, that's deductible. Whereas if you didn't have a home office, it might be considered non-deductible commuting expenses. Because, for example, commuting isn't deductible, but business travel is. So that's another important reason why oftentimes it's good to have a home office, but it's all going to depend on your individual situation, what your business is like, whether you have another location. Um, but with many people working remotely nowadays, it's important to understand what qualifies as a home office and how to qualify for the deduction. So let's see, Dave, any questions on this?
Yeah, let's just slide two quick ones in since we're somewhat running up on the hour. Depreciation is important, but first, does IRS have guidance on what is qualified or not qualified for expenses? And as an add-on to that, can you expense a portion of Wi-Fi or cell phone?
Yes. So you can go look at the form. I forget the form number off the top of my head, but you could Google business use of home and you can look at there should be a publication that goes along with it, along with an IRS form that walks through essentially all the deductions and it helps you do the calculation yourself. So that'd be good to review if you're just wondering. Yes, Wi-Fi would count. Cell phone, you can generally deduct, but if you're using for cell phone's a little different because it's not like a home cost. That'd be more of a business cost. You have to be careful to only deduct the portion that's like business use because some of it's used for personal use. I ran into this a lot when I worked for the IRS. So if you're using the same cell phone for, say, business use as well as personal use, you don't want to deduct 100% of your cell phone bill. You want to come up with a reasonable kind of percentage that is business use, um, whatever it is based on your usage. You could always just buy a second cell phone, but if you're using the same one, you want to make sure business use. And this will also get into the next section where we're talking about vehicles. Just because you have a vehicle that you use sometimes for business doesn't mean you can deduct the whole cost because some of that use is personal, but we'll talk about that in the next section.
Let's get one more conceptual type question. Something new to me, Andrew, that you pointed out was the ceiling on startup costs that you can expense. Um, conceptually, there's several folks that are asking questions. Would software fees, website fees count as a startup? Also, can the registration of a single member LLC be deducted as a startup? So I guess the conceptual question, Andrew, is if there's a ceiling on deductible startup fees, but after you start up and it's a normal business expense, is there a concept our listeners could take away is it okay to not charge it as a startup expense, just a normal business expense after startup has occurred?
Yeah, so if those expenses are incurred after you're in business, then they wouldn't be startup costs, which is kind of what I was getting at as the benefit of getting in business as soon as possible, opening your doors, trying to sell something because um, you've started your business. So yes, I would say try to push as many expenses as possible if you think you're going to be over $5,000. Because if you're under $5,000, it doesn't matter because it's all going to be deductible the first year anyways. But if you're over startup fees of over $5,000, I would try to push as many as possible till after you actually open your doors for business because that will unlock, the best and quickest deduction possible. But yes, things like websites, all of those are deductible expenses. This really just gets into a timing issue of if it's considered a startup expense and subject to those limitations, or if it's just a normal expense after you've opened your doors.
Thank you, Andrew. Let's move to depreciation, then we'll wrap up with whatever questions we.
Okay, great. So let's do a quick run through of depreciation. I'm sure you've heard about depreciation before, but let's go through what exactly it is. So if you make a big purchase, say equipment, property, a vehicle, the general rule is you can't deduct that cost all at once. Instead, you generally spread the cost over what's known as its useful life. So if buy a piece of equipment that is supposed to last for 10 years, then the standard accounting rule is you deduct that 1/10 of it each year. There is the IRS uses special depreciation schedules, but there are special types of depreciation called Section 179 expense and bonus depreciation that lets you deduct, the entire expense in year one. So it generally applies to things like equipment, vehicles, other hard assets. It doesn't apply if you purchase land. Land is never depreciable. But if you buy equipment or vehicles, rather than being subject to that standard rule of having to deduct it over time, you can bring all that expense into the year you purchase it. And the reason why we like Section 179 expense and bonus depreciation, or just generally termed accelerated depreciation, is because it's the whole concept of time value of money. So say I purchase a piece of equipment for $50,000. A tax deduction of $50,000, which essentially reduces my taxable income by $50,000, that's worth a lot more to me than spreading that out over, say, 10 years and getting, $5,000 each year for 10 years, because $5,000 10 years in the future is not worth the same as $5,000 today. So this is really about time value of money. There's two ways to do this accelerated depreciation, write it off all in year one. There's Section 179 expensing, which is an election to deduct the full cost in year one. There's also bonus depreciation. Really, these two things work very similarly. They let you write off the entire cost of equipment in the first year. There are some differences between both of them, but they essentially get you to the same place. Bonus depreciation is used more often because it's just not subject to as many limitations. There's no limit on how much you can expense. And also, there isn't an income limitation, meaning if I'm in my first year of business and only generate $10,000 of revenue, but I buy a piece of equipment for $50,000, I can deduct that cost of the equipment of $50,000 and use that to create a loss on my tax return. Whereas Section 179 expensing, you are subject to limitations if you purchase a lot of equipment. If you're a startup, you may not be purchasing. The limits are pretty high. They're a few $1,000,000. But the deduction is capped at taxable income. So, for example, $10,000 of income, $50,000 in equipment, I can only deduct 10,000 and would have to carry that remaining 40,000 forward for future years. Whereas bonus depreciation isn't subject to those limitations. So generally speaking, you're probably going to use bonus depreciation most of the time, but I just like to flag that Section 179 is out there. But like I said, it really gets you to the same place of being able to deduct equipment purchases fully in the year you purchase them. So let's talk about vehicles because this is a common one. Also, you'll see, a lot of, you know, misinformation on social media about buying a vehicle, deducting it for tax purposes. So, um, you probably hear a lot about, buying a SUV or an influencer on, TikTok saying, deduct the full cost of your G Wagon or whatever. They can't unlock big write offs because heavy SUVs and trucks aren't subject to these luxury auto limits that limit the deductions. So if you bought, for example, if you bought a BMW SUV over 6,000 pounds, that's not subject to a limitation. But if you bought a BMW sedan, that would be, which is kind of silly, but that's just the way tax law works and the way the law is written. But another important thing to keep in mind is that if your business, buys a vehicle and you're depreciating it, your business use must exceed 50%. Um, Otherwise, you don't get any depreciation. So that means at least half the time you have to use your vehicle for business, and then only 50% of your expenses would be deductible also, because you're always limited to being able to deduct the business use percent of your deduction. You must also remember to keep a mileage log. I also put down at the bottom, you need to watch out for recapture. So this means if you sell a depreciated asset, then you essentially have to pay that tax back. So I'll just give an example. Say I bought a car for $50,000. I wrote all of that off the first year because I met the requirements. So now my called basis in the car is zero. If I sell that car a year later for, say, $40,000, you might think, oh, I lost money on that car because I bought it for 50. Um, that's true there, but you took the whole write-off on your taxes, so you actually have a $40,000 gain because for tax purposes, you've deducted the entire cost. So when you sell it for $40,000, you actually have a gain of $40,000 now to report on your taxes. So I'm saying that to be mindful of what your exit strategy is with equipment, because if you end up selling it down the line, you actually might be subject to a tax bill you didn't think you were going to have. But generally, accelerated depreciation is good because you get those deductions fast. It can help reduce your taxes, improve cash flow, especially when you're starting your business. So you have more funds to, reinvest in your business rather than, pay taxes with those. So I know I went through that quickly, but let's go. We have time for questions. I will also mention one thing. I published a book a few months ago called The IRS Survival Guide. It's all about has stories from my time at the IRS and how I deal with IRS issues. It doesn't really go into too many of the business things we talked about in this presentation, but if you're interested, feel free to use that QR code, go to the website. You just have to put in your name and email address, and you can download a free copy. Um, so I'll leave this up on the screen for a minute or two. But let's, Dave, let's get into some more questions with the remaining time we have.
Well, this is some great information, and Andrew, as always, and evidenced by the number of questions coming in. Your content and presentation is great. I will mention to the crowd again that this webinar will be recorded. It'll be available on the score.org/Charlotte site under resources. And Andrew presents another webinar for us called Navigating the Legal Landscape. And there's some common information presented between the two presentations, but there is some very distinctly different information. And I encourage all the listeners to go to our website, review the resources that are available from the SCORE site, whether it be Andrew on the accounting and legal side of things or other subject matter. There, Andrew, we can probably, and that we're over time, but that's okay. Let me just, I had lost the time. Please reach out to Andrew. He's busy fellow. As he had mentioned, he does typically represent clients that are deep in an IRS negotiation of some type. But he is kind enough to help us. Let me just pull up the question and answers. There's a number. How about if I do not have a mortgage or rent payments, can I charge the home business monthly rent? So apparently the house is paid for.
Um, if you're just a sole proprietor or essentially or taxes sole proprietor, it wouldn't make a difference because you're really like the money's just going in one pocket and out the other. So it's not going to make a difference tax wise. If you do have an S corporation, you do have to do the home office deduction through it's called like a reimbursable plan. So you'd have to have a written plan between essentially the business and you, saying like, oh, the business is sort of renting an office for your use. But that'd only be if you have a separate kind of tax classification. But if you're just a sole proprietor, then um, I wouldn't charge you monthly rent because it's sort of you'd have to report it as income personally and then report it as a deduction on the business, and it all just get washed out in the end. So you wouldn't be any better off.
One last quick question, and the question is: would a shed, and I'll paraphrase, or another structure on the property, but would a shed on property qualify for a home office?
Yes, it should. I'd have to look into, I don't know all the requirements for like separate structures, but as long as you're using that regularly and exclusively for business, you should be able to deduct that. So, if you have a shed that maybe you're storing equipment or supplies in and are using that regularly and exclusively, that should qualify. I would double check. There should be good information in that publication. I don't know off the top of my head if there's any other like special requirements for separate structures from the house. But that would just be something to check into. But I believe it would qualify.
Great. Well, again, thank you, Andrew, for a great presentation. We had so many folks on here. I think it topped out at 91, which is great. Thank you. And Andrew, look forward to your next presentation on a SCORE webinar. In the meantime, folks, I'd like to just share one additional note for SCORE, and then thanks for joining us, and have a great day. Thanks, folks. Look forward to the next webinar presented by SCORE Charlotte. Have a great day.